Welcome to the deep dive. We cut through the clutter, look closely at the sources, and pull out the key insights just for you. Today, we're really getting into the leads on decentralized finance, DeFi. It's moving so fast, and well, people are already calling 2024 a massive transformative year for it. We want to figure out why. So for this deep dive, we've lined up some really interesting stuff. We've got an analysis looking ahead at DeFi's comeback, a deep look into stablecoins, the good and the maybe not so obvious bad, and also a really vital chat with an innovation investor and a crypto expert looking back at a really key moment in crypto history. Okay, our mission today, pretty clear. We want to unpack this big DeFi comeback, look at the cool new tech driving it, but also, break down the risks and challenges people maybe aren't talking about enough, and we'll pull lessons from past bumps in the road. It's all about getting you that quick, solid understanding, maybe some of those aha moments, and figuring out what really matters without, getting totally lost in the jargon. Let's jump in. All right, let's start with the big picture.
DeFi's making a serious comeback after that slump in 2022, 2023. Was really powering this.
Yeah, it's definitely more than just prices going up again. What's interesting is this revival seems, well, structural. It's being fueled by a few things coming together, clearer regulations on the horizon, some genuinely new solutions popping up, and core tech getting better in ways that actually solve real financial problems.
And you can really see that in the numbers, can't you? That total value locked, the TVL, it's shot past $100 billion.
Yeah.
That's not just a random number, right? It shows real trust, real capital flowing back in.
Yeah.
It's a big climb from late 2022 lows, about, 80% of the all-time high back in late 2021?
Exactly. And it tells you that even though token prices took a hit, the underlying infrastructure, the value being used in these protocols, it's still really strong. It shows the ecosystem's maturing.
Right. And stablecoins, too, their market cap is back up to $168 billion. That's huge.
Yeah.
Over 90% of the 2022 highs. Clearly strong demand there for those dollar-pegged assets. And the trading volumes, still pretty high, averaging around $6.9 billion a day since March, maybe 70% of the peak, but it shows people are still actively using DeFi.
And if you zoom out a bit, the whole DeFi landscape is getting much more diverse, multi-chain. Ethereum's still the biggest player, yeah, but its dominance has shifted. Think back to DeFi summer 2020, it was over 95% Ethereum now. It's closer to 62%.
It's a big shift. So where's that value, that TVL, moving?
Well, it's spreading out. You see it on rival layer ones like BNB chains, Solana, Tron, plus all those layer 2 networks built on top of Ethereum. And it's even wider now. Bitcoin's getting in on the action with decentralized exchanges, new token standards like ordinals, runes.
Yeah.
It's definitely broadening the whole space. It's not just an Ethereum game anymore.
Okay, so that diversification is key. And this really leads us into the innovation side, which feels like where the real excitement is. These big tech advancements seem to be pushing us towards what people are calling DeFi 2.0. What's that actually about?
Right, DeFi 2.0. It's not just a buzzword. It's really about a strategic shift, focusing on making things sustainable, scaling them up properly, making them more secure, and honestly, just making them easier to use. Better interfaces, stuff designed to bring in regular people, not just crypto natives. It's about building for that next wave of adoption.
And we're seeing some really interesting trends emerge from that, like liquid restaking tokens, LRTs. Their growth has been nuts. Went from, $264 million early in 2024 to nearly $14 billion by the middle of the year. That's staggering. How do they work exactly?
Yeah, LRTs are a big one. They basically simplify staking Ether, but the key thing is they let you keep your capital liquid while it's staked. Think EigenLayer, EtherFi, Lido. So that capital isn't just locked away anymore. It can be used again in other DeFi applications. It creates this kind of super liquidity layer, potentially unlocking huge capital efficiency. That's a massive deal for scaling things up.
Right, making staked assets usable again. That sounds powerful. And what about those scaling issues, like on Ethereum?
That's where layer 2 scaling solutions come in. They're crucial. Think of them like express lanes next to the main highway. They take a ton of traffic off the main chain, makes transactions way cheaper, faster. But also, importantly, they enable new kinds of apps that just wouldn't work cost-wise on layer 1. That's key for bringing in millions more users.
Makes sense. So faster, cheaper.
Yeah.
What about making it just, easier, less complex for the user?
Yeah, exactly. That's where things like intent-based architecture are really interesting. They simplify how you interact. Instead of figuring out all the transaction details, you just say what you want to happen, like swap this for that at this price, and the system figures out the how. Uniswap X, Aperture Finance, they're working on this.
Okay, that sounds like a potential game changer for user experience. Definitely lowers the barrier. What else is part of this DeFi 2.0 picture?
Well, there's a lot of focus on cross-chain solutions, too. breaking down those walls between different blockchains so they can talk to each other. Platforms like Polkadot let you move assets around smoothly. That helps with liquidity, makes the whole experience better. And then improvements in liquidity provision, LPs. Traditionally, liquidity could be spread really thin. Concentrated liquidity pools are a big step up. They let providers focus their capital in specific price ranges where it's most needed. Way more efficient. Means LPs can potentially earn more with less capital tied up. Makes providing liquidity smarter.
More efficient LPs, better cross-chain.
Right. And more sophisticated tools are showing up too. DeFi derivatives, futures, options, swaps for more advanced trading and managing risk, all on-chain. Governance is changing too. DAOs, decentralized autonomous organizations, are becoming the standard way to run these protocols. Community-driven decisions, more transparency, like Uniswap DAO, MakerDAO. Actually, with MakerDAO, it's interesting. Something like 40% of their DAI stablecoin was backed by real-world asset collateral as of June 2024.
Wow, okay. Speaking of real-world assets, that whole tokenization of RWAs thing sounds huge, like a real bridge between old finance and DeFi.
Oh, absolutely. It's massive, bringing things like real estate, commodities, even stocks and bonds onto the blockchain. And it's not just theory, it's happening. Big players are tokenizing traditional funds. It opens up new investment opportunities, makes things accessible to more people, both retail and institutional. It really expands what DeFi can touch.
So much innovation.
Yeah, and underpinning all of it has to be better security. There's a definite push for more rigorous audits, better security tech, things like decentralized identity, and even decentralized insurance. Building trust is absolutely essential for wider adoption.
Okay, so with all this amazing innovation happening, pushing towards DeFi 2.0, what are still the biggest roadblocks? What's holding back that, full mainstream adoption and integration with traditional finance?
Good question. I think even with all the tech advances, the biggest hurdles are still regulatory clarity and really smoothing out that user experience. We're starting to see big financial institutions dip their toes in, integrate DeFi protocols, maybe launch hybrid products that brings legitimacy, big capital. But they absolutely need clear rules to operate under. And honestly, the user experience still needs to be as seamless as, using your normal banking app. That gap needs to close.
Right, the regulatory fog and the user-friendliness. Okay, let's switch gears a bit, but stay related. Stablecoins, they're obviously central to a lot of this, and there's so much buzz, right? Circle going public, Stripe using stablecoins, Visa integrating them, even Amazon and Walmart supposedly looking at it. The U.S. Senate passed that Genius Act for USD-backed ones. But, despite all that excitement, what are the risks or the maybe hidden problems that people should be aware of?
Yeah, it's a really important area. Stablecoins are huge, no doubt. $255 billion market cap, almost all USD pegged, super useful for crypto trading. But, and this is the key thing, there are about 9 pretty significant frictions and risks that often get glossed over when people talk about using them for everyday payments.
Okay, let's break those down. What's the first one?
Network transaction fees, gas fees, right? On networks like Ethereum, users pay these variable fees. Now, layer 2s can help bring those down a lot sometimes, but using layer 2s adds another layer of complexity, and depending on the specific L2, might even change the security assumptions a bit for that transaction.
Okay, fees. What's next?
Fragmentation. Think about it, unlike your bank account where dollars are just dollars, your stablecoin balances might be stuck on different blockchains or different types of stablecoins. You can't just easily pool them together. And wallet incompatibility is a real thing. You could actually lose access to your funds if you send them to the wrong type of wallet address.
Yeah, that sounds messy. And what about fraud?
That's a big one. Because stablecoin payments are usually instant and irreversible, the risk of fraud goes way up. Estimates are like $12.4 billion lost to crypto fraud just in 2024. And the protections we have in traditional banking, like Reg E in the U.S. for electronic transfers, they might not fully apply here. And that Genius Act you mentioned, it doesn't seem to add much in the way of fraud protection, at least not currently.
Okay, so fraud risk is high. What else?
Well, you still generally need banks and exchanges, right? To get stablecoins in the first place or cash them out back to regular money, you almost always need a crypto exchange account and probably a linked bank account. That brings in KYC, know your customer rules, which can be a barrier for financial inclusion for some people.
Right, the on-ramps and off-ramps.
Exactly. And finally, for the user side, the whole cross-border remittance thing. People talk about stablecoins being cheaper for sending money internationally, and maybe sometimes they are, but you still have foreign exchange costs when converting, plus other complexities for the person receiving the money. It's not always the simple, cheap solution it's made out to be.
Okay, those are some real user-level challenges. What about bigger picture, like economic risks?
Yeah, there are definitely macro-financial concerns too. One is how stablecoins could affect banks. If lots of people pull money out of bank deposits to buy stablecoins, banks lose that stable, sticky retail funding. They might have to rely more on wholesale funding, which is more volatile. And imagine a run on stablecoins, everyone trying to cash out at once. That could mean huge sudden shifts of money out of banks, potentially hitting their stability. Remember Circle pulling $3 billion from Silicon Valley Bank back in 2023? That kind of thing.
Right, the bank stability angle. What else?
Business model risk for the issuers themselves. Companies like Circle, their revenue, like 99% of it in 2024, comes mainly from the interest they earn on the reserves backing the stablecoins. If interest rates fall significantly, that revenue could get squeezed hard. Plus, historically, some issuers haven't been totally transparent about reserves, claiming 100% cash equivalents when they actually held riskier assets like corporate debt.
Transparency is key there.
Absolutely. Then there are the overseas issues. Dollarization and sanctions evasion. USD stablecoins spreading globally can make it harder for other countries to control their own monetary policy. That's unintended dollarization. And, well, it's pretty clear they've been used to get around financial sanctions. Tether, reportedly, enabled billions in evasion. So authorities in other countries might crack down on their use because of these effects.
Okay, dollarization, sanctions.
Right.
What's the last big one?
The most fundamental one, maybe? Depegging risk. Stablecoins are pegged to the dollar. They aren't actual dollars. And that peg can break. We saw USDC wobble briefly in 2023 because of the SVB fears. And the Terra USD collapse in 2022 is catastrophic. It kind of reminds you of the old free banking days where you had to trust the specific bank issuing the currency note. The issuer's brand mattered. We moved away from that in traditional finance for very good reasons.
Wow, okay. Those are some serious considerations. And these risks really underscore why it's so important to look back and learn from major past events. Let's talk about one of the biggest stations, the collapse of FTX back in November 2022. That was a massive wake-up call, wasn't it?
Oh, absolutely. A huge shock to the system. The timeline was just wild. FTX denying problems, then suddenly bankruptcy, Binance almost stepping in, then backing out FTX's terrible books. They ended up with an $8 billion hole. And the core reason. It came out that FTX had basically lent billions of dollars of customer money to its sister trading firm, Alameda Research, for really risky bets.
Just staggering. To really get a handle on what that meant at the time, let's bring in some perspective from back then. We have insights from Lamar Wilson, founder of Black Bitcoin Billionaire. He had some sharp takes on how it all went down.
Yeah, Lamar's analysis was really insightful. He talked about the monopoly money problem. He pointed out how VCs and lenders let FTX use its own token, FTT, as collateral for massive loans. Using your own made-up token as collateral, it just created this illusion of value, massive leverage built on nothing. And he said when Binance's CEO, CZ, announced he was selling off his FTT holdings, that was the pin that burst the bubble. It just, like Lamar said, pulled the curtain back on the whole Wizard of Oz setup.
Wow. And Lamar had some really direct advice for people listening then, right? Something about exchanges.
He did. His big takeaway was, get that Bitcoin off the exchange. He warned that a lot of these exchanges were operating fractionally reserved. They were selling people Bitcoin they didn't actually hold. So when everyone rushed for the exits, a bank run, basically, but on the exchange, they just didn't have the assets, they collapsed.
Not your keys, not your coins, as they say.
Exactly. Lamar also used a great analogy of the casino. He said, look, a lot of these tokens are just chips in a casino, just bets with no real underlying value. Bitcoin, he argued, is different because it requires work, proof of work, that computing power to create it. That gives it an inherent cost, a layer of value. He really stressed understanding Ponzi schemes when looking at DeFi.
So the big lesson here isn't just about FTX, is it? It's about understanding what you own, where you own it, and the risks involved with intermediaries. Custodial risk.
Precisely. It underscores the importance of understanding the asset itself, but also how you hold it. Do you really own it, or does someone else hold it for you?
Which brings us perfectly to our term of the week, cold wallet. Now, many of our listeners probably know this, but after FTX, the why behind cold wallets became crystal clear.
Yes. It's not just about hackers, though that's important. It's fundamentally about eliminating that counterparty risk. When your assets are in a cold wallet, you control the private keys. Their security doesn't depend on an exchange staying solvent or honest.
Right. So how does it work, basically?
Well, you have a physical hardware device. You only connect it to a computer, briefly, when you need to get a receiving address or sign a transaction to send funds out. Once you've done that, you disconnect it. Your private keys, the things that actually control your crypto, stay offline, air-gapped, safe from online threats. It's the total opposite of a hot wallet, which is connected to the internet, like the ones on exchanges.
So it really makes you ask yourself, right, how are my assets stored? Am I comfortable with that level of risk?
Exactly. It's a crucial question every crypto holder needs to answer for themselves.
Okay, let's shift perspective again now. Let's think broader about innovation itself and investing for the long haul, even when markets are, well, crazy volatile. We're going to tap into some thinking from Kathy Wood of ARK Invest, again from back in late 2022, right after the FTX mess.
Right. And it's interesting because at that time, her funds were down significantly. ARKK was off, over 65%? But she was still incredibly bullish on innovation. She talked about three big revolutions she saw coming from blockchain tech. First, the money revolution, a global, digital, private, rules-based money system. Second, the financial services revolution, which is basically DeFi. And third, Web3 creating the first truly global system for digital property rights, driven especially by younger generations and their online identities.
And she had some interesting thoughts on investors and time horizons, didn't she? Especially with this kind of disruptive tech.
Yeah, she observed that public market investors, especially in the US, can be really impatient, super focused on quarterly earnings, short-term results. But disruptive innovation, almost by definition, doesn't follow neat quarterly cycles. It's messy, it's volatile, especially early on.
So patience is key.
Critical, she argues. And interestingly, she also suggested that for active managers, trading around that volatility, leaning into it rather than running from it, could actually boost returns over time if you understand the long-term trajectory.
And she thought sticking to old benchmarks was actually riskier now.
That was her view, yeah. That in a world changing this fast, clinging to old measures of value is the real risk. She saw these five huge innovation platforms converging genomics, robotics, energy storage, AI, and blockchain. And she believed these weren't just growing linearly, they were set for explosive, exponential growth as they fed off each other.
So does a recession even matter for tech like this, in her view?
Well, her take back then was that innovation actually tends to power through recessions. And she anticipated interest rates and inflation falling in 2023, which she thought would be a tailwind for these kinds of growth stocks.
Her core philosophy, learned from her first boss, Sig Sigala's, seems to be
Innovation solves problems. Simple as that. And solving big problems creates massive growth opportunities if you're invested in the solutions.
right. And she also believes innovation levels the playing field.
Yeah, that was a cool point. She called innovation the great leveler. Her idea was that anyone really can become an expert in these new fields like 3D printing or AI. You don't necessarily need a fancy degree. You can follow the experts online, read the research. The knowledge is out there and accessible in a way it never was before.
And her favorite investing term really sums up her outlook, doesn't it?
Exponential growth.
Yeah.
Yeah. She really contrasts that with linear growth, which is how most people think, how most traditional industries grow. She uses Amazon, the internet as examples. They start slow, maybe look disappointing for a while, but then they hit an inflection point and just explode upwards.
And her argument was that investors missed out after the dot-com bust because they got scared.
Exactly. They ran away because of the crash memory, but she argued the technologies themselves, like deep learning only really taking off around 2012 or DNA sequencing getting cheap enough recently, are now truly ready for prime time. So the irony, or the opportunity as she saw it, was that just when the tech is finally ready for that explosive growth, many investors are running for the hills again because of the current volatility.
Fascinating perspective. Okay, so wrapping this all up for you, our listener, what have we seen today? We've looked at DeFi's pretty remarkable comeback, the really cool tech pushing it into maybe DeFi 2.0, but also those critical risks, especially around stablecoins, that you absolutely need to keep in mind. And we've touched on the lessons from FTX custody, counterparty risk, and contrasted that with a long-term patient view on innovation.
Yeah, it's clear the DeFi journey is this ongoing effort to fundamentally rethink financial services. It's evolving constantly. So maybe a final thought to leave you with. As DeFi keeps maturing, as it gets more tangled up with traditional finance, what completely new challenges or maybe completely unforeseen opportunities might pop up next? How might those fundamentally change how you think about and interact with money and value in the future?